Hi, I'm Lindsay from KOSEC Kodari Securities, and today we'll be discussing operating margin. It's one of the key fundamental metrics utilized by KOSEC as part of our evidence-based investment strategy, and it provides insight into the profitability of a business and performance of its management. As always, all information given is general in nature and does not take into account your personal needs or objectives. For further information, visit our website www.kosec.com.au. So today, we'll provide an overview of this financial metric. We'll then explain how it's calculated, and finally discuss why it's important to equity investors and provide some practical examples from companies listed on the ASX. As mentioned, operating margin provides an insight into the profitability of a business and performance of its management, and is therefore an important consideration for equity investors. As the name suggests, it's a measure of how much operating profit a business makes per dollar of revenue before paying interest or tax. In other words, it evaluates how much profit a company makes from its core operations relative to its sales. So how do we calculate operating margin? Operating margin is calculated by dividing operating earnings by revenue. This will be expressed as a percentage. The numerator, operating earnings, is calculated by taking revenue, then deducting variable and fixed expenses, but not interest and taxes. And not surprisingly, this ratio is also commonly known as return on sales. So why is operating margin important? In short, operating margin is a measure of profitability that helps investors assess how well a company is being managed and how risky it is. It shows us what proportion of each sale ultimately flows through to profits from its core operations. In other words, what proportion of revenues is available to cover non-operating expenses, such as interest. Clearly, if operating margin is increasing, this is a sign of increasingly profitable core operations of a company. On the other hand, a company with highly variable operating margins could be assessed as being more risky. Operating margin also helps us understand how a business makes its money. In other words, is income being derived primarily from its core business, or is it coming from other sources, such as investments? Now, it's important to keep in mind that what constitutes a normal, or good, or bad operating margin is very much dependent on the particular industry or sector that the company is in. For instance, companies in the retail sector tend to display lower operating margins as they compete on price and rely on higher turnover to generate profit. For instance, in the 2019 financial year, Woolworths Group had an operating margin of 6.6%, while Coles Group had an operating margin of 6%. In contrast, companies in the healthcare, financial, or mining sectors may display higher operating margins due to rising asset prices and a lesser degree of price competition. However, prevailing macroeconomic conditions and trends will also play a large role. For instance, in the 2019 financial year, CSL had an operating margin of 33.8%. Macquarie Group had an operating margin of 38.8% on the back of continued strength in the equities and fixed income markets and corporate finance activity, while Fortescue Metals Group had an operating margin of 60.4% on the back of a rising iron ore price. So in summary, this means that a meaningful analysis of operating margin should involve a comparison with the company's industry peers, analyze whether it's stable, trending up, or trending down compared to the company's historical performance, and also consider broader macroeconomic trends and themes. So in this video, we provided an overview of the financial metric operating margin. We explained how it's calculated. It also discussed why it's important to equity investors and provided some practical examples from companies listed on the ASX. So I hope you found it helpful. This video was brought to you by KOSEC Kodari Securities.